I'm Adam Myers, an Executive Director at Pengana. Thank you for joining us today for this Pengana Alpha Israel Fund update. Before I hand over to the investment managers, who will talk more about the portfolio and some of the great investments that they are seeing at the moment, the investment opportunities, I thought it may be worthwhile to take a moment and explain Pengana's interest in Israel as an investment destination and our decision to partner with Alpha, who manage the underlying investments. I'll start with Israel and what it is that makes this tiny country with a population of around 9 million people such a compelling investment destination. And to give some context as to how tiny Israel really is, I calculated this morning that it would fit almost 350 times, the land would fit almost 350 times into Australia. And its population is just over 0.1% of the global total. So it really is a tiny country. And it's also a very business-friendly environment with a highly educated population who focus on research and development. And on the next slide, there are a bunch of other stats that evidence or support the unique position that Israel occupies as in the global tech ecosystem. It's an R&D hub. It has the greatest number of startups per capita globally. It has the second most companies listed on the NASDAQ of any other foreign country in the world outside of China. And the list goes on, it's all there to be read. And actually another great stat that I heard about a little while ago, which isn't on this slide, is about unicorns, which are privately held startups worth at least $1 billion. And so these were supposed to be as rare as unicorns. And over the last few years, 1 in 10 unicorns have been born in Israel. But these stats are really the outcomes. They don't explain why Israel occupies this unique position and what makes it different. And I think that it's easier to understand those things with some historical context. So apologies to the history buffs. I'm certainly not a historian, but my understanding is that Israel historically prioritized research and development simply because it had no choice. After Israel gained its independence in 1948, there was an influx of people into the country. Refugees who were expelled from the surrounding countries after the War of Independence. And of course, there were the European refugees who made their way to Israel after the Second World War. Between 1948 and 1955, the population of Israel more than doubled, and these people needed to be fed. But the environment in Israel, the geography and the topography weren't naturally suited to agriculture. In the north, it's mountainous. In the south, it's a desert. The coast was swampy. So improving the land so that it could be farmed and then coming up with water-efficient farming techniques was literally a matter of life and death. There wasn't any other choice. And today, Israel is a major exporter of both fresh produce and agricultural technology. And food security remains a major priority in Israel. It is now also one of the global leaders in developing lab-grown meat. The next defining event was in 1967, when 3 days before the Six-Day War, Charles de Gaulle, the French president, imposed an arms embargo on Israel and halted the delivery of fighter jets and a range of other military hardware as France reorientated its foreign policy towards supporting the Arab states. So we know from history that Israel won the war even without the military equipment from France. But it made that experience made the Israeli leadership realize that they couldn't rely on anyone else for their defense. Israel had no choice but to prioritize independent research and sort of independent research and development. It started with military development, but it rapidly spread to everything else as well. And finally, Israel has always had a highly educated population, but along the way, it also had quite a bit of luck. Between 1989 and 2006, about 1 million Russian Jews emigrated to Israel, and they brought with them skills, very high levels of maths and science, the kind of subjects we today refer to as STEM subjects, STEM skills. And that raised the game for the whole country at a very critical time in history. And there were obviously a bunch of other factors that contributed along the way. But I hope that these examples have given you a sense of why innovation is so ingrained into the Israeli culture. Dean, can you move to the next slide, please? Here is a small example of some of the countries that rely on Israeli technology to make their products work. Historically, Israel was a great startup nation. You may have read the book about that. It developed brilliant technology, started businesses, and then sold out. These businesses were sold to global conglomerates. And this was largely because the capital market development hadn't kept pace with the development of business and technology. Today, although it still happens, it happens less. And a major reason for that was the privatization of the Israeli stock exchange. This happened about 3 years ago, and it really changed the momentum because prior to that, the subset of Israeli companies that did go public tended to do so on foreign exchanges, mainly on the NASDAQ, but it's tough to be listed in the US. It's expensive. There's a high regulatory burden, and so staying private or selling out was a much easier path to follow. But today, the Israeli stock exchange has become a very viable option, and we are seeing a large increase in local listings. So the startups are now also growing into fully scaled businesses and great investment opportunities. We don't think of Israel as an opportunistic investment in investment destination in any way. But in terms of current positioning, I would like to highlight a few additional tailwinds. Firstly, with a vaccinated population, Israel is effectively post-COVID. The economy is open and it's thriving. 2 weeks ago, both Moody's and Standard & Poor's S&P reaffirmed the country's sovereign credit rating, and the currency, which I always think of as the share price of the country, has been rock solid, even through the recent conflict, which really shows the underlying economic strength. And secondly, the Abraham Accords, which refer to the normalization of relations with UAE, Bahrain, Morocco, and Sudan. There is huge economic potential associated with regional cooperation, and we're just seeing that starting to emerge. Next slide, please. I'm guessing most people watching this webinar will be familiar with the Pengana partnership model. We identify a niche or an investment strategy that we want to pursue. And if we can find a domestic manager who can manage a best-in-class solution in-house for us, we will always do that. But if we can't, we look further afield, normally overseas. And Alpha is one of the top performing fund managers in the Israeli market. The partners have significant experience and a proven track record. Their flagship value fund has outperformed its benchmark by almost 10% since inception, 10% annually since inception in 2007. And on the next slide, we see the Australian fund. Class A is AUD and B is USD. The fund performance is shown in green. So not only have both classes generated strong index outperformance since their inception in 2017, they have done so with much lower volatility and lower levels of drawdown. And this is largely due to the very structured approach that the investment team takes to portfolio construction. Sagi will discuss this in more depth as soon as he manages to wrestle the mic away from me. But on the next slide, we have the investment team. And joining us today, we have two of the four members, Gabi Dishi and Sagi Ben Yosef. I will now hand over to Sagi, who will talk a little bit more about some of the current dynamics in the semiconductor industry and how well placed the fund is to benefit as this semiconductor industry continues to grow. So over to you, Sagi.
Great. Thank you, Adam, and thank you all for attending. It is a real pleasure to be with you, all of you here today. So as you can see from this slide, our team is made up of people with a vast individual and collective experience investing in Israeli businesses. Three of us have worked together for over 21 years. As for myself, prior to joining Alpha, I was a founder and partner of a family office business that had a joint venture with Alpha since its inception. In early 2018, we initiated a joint venture in Australia to form the only vehicle of this kind, an Australian unit trust that offers Australian investors access to an on-the-ground fund manager with expertise in investing in Israeli companies. We believe that this unique vehicle is a great opportunity for you, Australian investors, to benefit from a thriving Israeli economy and its global leadership in technology. Our universe of investments, as Adam mentioned, include Israeli companies traded either on the Israeli Stock Exchange as well as other global exchanges, mainly on the NASDAQ. Next slide, please. Thank you. A major benefit for Australian investors, as we see it, is the ability to diversify their global equity exposure by including Israel as part of their global asset allocation. This means investment in sectors and companies which are either hard to find or do not exist on the Australian Stock Exchange. For example, high-tech and specialized sectors such as semiconductors, which, as Adam mentioned, will be the focus of our presentation today. As many of you will be aware, we are in the midst of a massive shortage of semiconductors at the moment. Shortages are not unfamiliar in the chip industry, which regularly swings from undersupply to oversupply. Capacity was tight even before the pandemic because capital investment by chip makers in plant and machinery had been well below average for many years. But when the pandemic arrived, after an early crash, chip demand started a boom as consumers bought laptops, gadgets, and work from home led to increased demands on cloud computing operators, which require very high-end chips. Then, of course, we saw increased demand for cars, and the car companies, which all canceled their orders earlier in the pandemic, were now doubling up on their requirements. So basically, the combination of tight supply, massive additional demand, and a few other supply disruptions, including a fire at a Japanese chip maker, have led to our current situation. But importantly, even though all chip makers are now announcing massive increases in capital expenditure, we don't see this demand being reduced because our dependence on technology is only increasing with it. Comes demand for even more advanced semiconductors, and so much of that development takes place right here in Israel. It is very important to describe the global landscape behind the names of the companies showing on this slide in front of you and how it relates to Israel. The world's technology leaders are trying to maintain their advantage through designing their own chips. Google intends to develop in Israel the advanced processors needed for its data processing centers. Microsoft, which already employs about 150 local chip design engineers, which are engaged in the development of chips for its Surface products, is currently establishing a new center in the Haifa area, which is in the north of Israel, to develop processors for its cloud computer service. The newest addition in Israel is Facebook, whose development center is focused on processing and storage for the company's data centers. Even the head of Facebook's silicon and chip development in the US is an Israeli export by the name of Ofer Shacham. Just in April of this year, Intel unveiled the highest performing data center processors produced in Intel facilities in Israel. This processor is optimized for the cloud and high-end computing and promising a performance of 46% higher than the previous generation of products. The core of the processors, called Ice Lake server, launched recently by the US tech giant, was developed in Haifa and produced in the plant in Israel. In the first days of May 2021, just recently, Intel announced that it will invest another $600 million in Israel to expand its research and development, and confirmed it was spending $10 billion on a new chip plant, the third in Israel. Now you ask yourself, how does this link to our fund? Well, one of the methods that these companies use to maintain their technological advantage is by acquiring the local cutting-edge innovative companies. Historically, many of these acquisitions have been unlisted, but as the stock exchange continues to develop, as Adam mentioned, we expect more companies to be listed, and the Pengana Alpha Israel Fund is well placed to benefit from this activity. Two of our portfolio holdings have been acquired in the last 3 years since the fund's inception. KLA Tencor, an American company, bought Orbotech for $4 billion, and NVIDIA bought Mellanox for $7 billion. Chroma, a Taiwanese company, currently holds 20% of a Comtech, which is a company that we will discuss further shortly. Semiconductors remains a key focus for us. Israel's renowned leadership in this sector for many years, and our local presence provides us with a massive advantage. In this sector, major barriers exist that prevent new competitors from entering the market. Most notably is the intellectual capital and ongoing R&D requirements. We all know autonomous vehicles, personalized medicine, the Internet of Things, precision agriculture, mobile robots, computers that speak and understand natural language, and many other developments we cannot even yet to imagine will continue to feed the demand for specialized processing capabilities. Analysts forecast that this demand will triple by 2025. Israeli companies are market leaders in developing chips and processors that can deal with massive amounts of data and complicated tasks. And the tasks become more complicated. The amount of data that needs to be processed increases. And as chips become more specialized, the potential for failure increases. So we don't only invest in the companies which design and develop these specialized chips, we also invested in a very interesting company by the name of Comtech that I mentioned earlier, which is a market leader in a chip testing and quality control process called optical inspection. This is my cue to hand over to my partner, Gabi, founder and head of investments in Alpha, who will talk about Comtech and take you through a few of other companies in our portfolio and the different strategies we use in the fund. Thank you.
Thank you, Segi. So as Segi mentioned, in the semiconductor sector, we focus on the control process of the electronic chip manufacturing segment, which Israel is well known for. One of the fund's main semiconductor investment is Comtech through its parent company, actually, Prioritech. Prioritech is a holding company that engages in printed and semiconductor circuits through its two semiconductor subsidiaries. Comtech, which is duly listed in Israel and on the Nasdaq, is basically a global leader which offers optical inspection systems to the semiconductor manufacturing and packaging industries. And Access Semiconductor, which is a Chinese company. Both companies provide capital equipment, technologies, and manufacturing services globally. Inspection and metrology equipment is a key factor in adopting new technologies and products to achieve high yield and stability in production. Comtech is already one of the leaders in the industry, and I will try to explain why we believe it will actually continue to lead and why we prefer to hold it through its holding company. To understand it, we should start with understanding the key industry trends. First, maybe as Segi mentioned, the semiconductor industry continued to grow, and Camtek serves a fast-growing segment. That's the basic. There is no doubt that the connectivity trend will increase. The progress in the IoT will increase, the need for more 5G sensors and new RF modules, of course, and it's all supported by big data analytics that requires high-performance packaging. Second, the advanced packaging is becoming the standard solution, and Camtek is considered the market standard for metrology and leader in inspection. Within advanced packaging, features become much smaller and denser. Camtek can handle any level of complexity. Maybe it sounds obvious, but it is one of the most complex issues that the industry handle with. And there is another thing, which is the zero defect concept. It's adopting in the industry, and Camtek meets the most stringent requirements. And last, the majority of semiconductor manufacturing occurs in Asia, and Camtek has the strongest history and presence in Asia. I will end this slide by adding that in the last year, we replaced our holding in Camtek with its parent company, Priortech, as I mentioned in the beginning. The main two reasons were that Priortech also hold a very promising Chinese company that actually Priortech established and acquired partly by Chinese companies. And this company is with a big potential, and we believe, and actually they already announced that they will take it to an IPO by the end of the year. Second reason was that we found an arbitrage situation, since we took into consideration that even without the IPO, we effectively bought Camtek at a 25% discount when buying Priortech. My next example is Payton, very different one. Payton is a global leader of planar magnetic technology, which is a very efficient way of producing power transformers. Payton is also duly listed, but this time in Israel and in the Euronext in Brussels. And over the past 25 years of incremental research and development, they've built a range of state-of-the-art and custom design magnetic solutions, which are used in a range of industries, from automotive to aviation, medical device, industrial applications, but mainly data centers. So what is the real difference between Payton planar magnetics to the regular transformers that we all know, the big ones? I think that first is the size and weight. Payton's transformers are much smaller and lightweight compared to regular transformers. Actually, it is up to 10 times smaller and lighter in weight than their comparables. Second, it is also much more high efficiency and easier to cool. Again, it might sound very easy, but it's one of the most complex issues, mainly for the data centers and the electric cars. Payton was also a company with a low profile, and actually that's how it all begins for us. They started getting in the segment of thin transformers for televisions and gaming consoles. They had a few deals with LG and Sony PlayStation. This market was limited, and sales were mainly project-oriented. Over the years, the need for Payton technology increased exponentially, and new markets opened for the company products, especially, as I mentioned before, to the electric cars, data centers, aerospace, and more sectors. All of them needs much smaller size, low power consumption, high efficiency, and very reliable transformers and power distributions. We see exponential growth for this technology because of the market trends, and it works in favor of patent planners in things like increased frequency, power density, green energy, customization, which is very important, especially in the electric car, and fast reaction. The growth engines for patent planners are demand for compact solutions, supporting technologies, high-frequency semiconductors like SiC and GaN to allow high-frequency power supply. All components need to able and to handle high efficiency. Of course, the green industry as well. The big potential for patent planner technology is in the automotive market due to the following characteristics that are needed. Mostly in battery charges, long design cycle, demand for a compact design and cool environment, again, one of the biggest problems that they all handle with, and of course, the electric vehicle and the hybrid electric vehicle. Actually, Payton biggest clients in that segment of the electric cars are Volvo and Renault. We strongly believe that the EVs and the AI adoption will continue to drive Payton growth in the long term, and they'll all need cooler and smaller transformers. My next and maybe last example is again very different technology and company. Founded in 2013, Electrion strive to revolutionize e-mobility with the ultimate goal to eliminating the dependency on oil. Electrion is a global leader in developing and implementing electric road system, a shared invisible platform that wireless charges commercial and passenger electric vehicle. Electrion is paving the way for future green e-mobility with a unique smart road technology by developing a dynamic wireless electrification systems for electric transportation. Electrion's voluntary technology reduces the need for a large battery in the vehicles and powers it wirelessly via minimal infrastructure located under the driving lane, eliminating the need to stop for charging or refueling the vehicle during the day. Amazing technology from our point of view. Once the systems has been deployed in the main roads it's going to start with public transportation, then it can serve as a platform for all kinds of vehicles, eliminating the initial costs. The company which develops and implements wireless electric road systems has completed the deployment of 1.65 kilometers of a dynamic wireless charging systems on the public road in Gotland, Sweden, which is the largest deployment of its kind in the world. And it's currently now engaged in similar projects in Italy and Germany, and actually one smaller here near the Tel Aviv University. The problem of fleet owners and challenges in EV transition, which Electrion is addressing, are CapEx and real estate. CapEx requires requirements for charging infrastructure and big real estate footprint. Scalability of batteries, size, weight, and of course price, battery decline with fast charging. Efficiency and future-proofing. High operating cost, time cost of plug-in charging, fleet underutilization due to downtime required to charge, and shared charging infrastructure. No one charging solution fits all. Different vehicle types and size each required different solution. There is really no scalable and sustainable charging solution to suit every fleet type. Existing solutions compete on charging time and are not autonomous vehicle compatible. Electrion is the first company to offer fully wireless charging for any road vehicle in any state parked or in motion. We believe Electrion is perfectly accelerating towards transition to electric transport by leveraging existing road infrastructure and Electrion's proprietary wireless charging technology to eliminate range fear and lower total cost of electric fleet ownership. It is very important to add by the end of the slide that compared to the first two other examples, this kind of investment has a much more higher risk profile since it's a disruptive technology, of course. The fund will continue to exploit and invest in both low and high-tech companies with proven cutting-edge technologies. We will continue to focus on technology segments of which Israeli innovation is renowned for. A list of them you can see present in that slide. Since we are talking about investment in public companies rather than venture capital investments in startups, we expect a higher conviction when conducting our due diligence, and we would often like to see companies with existing sales to serious and leading entities and a clear profitability model. In addition, since this is an endless fund, an evergreen fund actually, there will be periods that when we will see much more investments in growing companies then that may change the face of the industry, and sometimes a little less. We are today at the inflection point where some of the companies in that segment of much more disruptive technologies have actually been sold in the past years. Companies that you maybe heard their name or read about them in our monthly letters, like Mellanox, Gencel, and Sonovia, which were sold at a very large profit. And on the other hand, we have recently entered a number of new companies, such as Glassbox and Pulse & More, that you can see here on the slide. I don't want to take too much time and go in too many details, but Pulse & More, as an example, is a company where, as far as we are concerned, all parameters are there for the company to become a market leader in the field of ultrasound telemedicine. The company has a breakthrough innovative development in the area of ultrasound. The company has developed a small home ultrasound device that connects to the phone. The company's big advantage is that the cost of the product is significantly lower than ultrasound devices, and also allows a woman using it to perform an ultrasound scan easily from home when the photos and the videos are uploaded to the cloud and actually examined by the doctors. This product solves the problem of running for the doctor's examination due to a fear of irregular problems such as heart rate and much more. It, of course, reduces cost for the insurance companies and hospitals, and provides flexibility to the pregnant women without risk from visiting hospitals. The COVID-19, of course, increased the situation significantly. The company has signed a very large agreement with Israel's biggest health plan by the name of Kupat Cholim Klalit, and its products are approved for sale in Israel and Europe, and is in the process of getting FDA. We have been in contact with the company for almost a year, actually 11 months, and actually help them to take it to an IPO. In addition, the company recently reported negotiations with a number of entities in Europe and the UAE. So those are the companies that we look for. To link the topic of our presentation to what we actually do, I would like to talk briefly in the next few slides about the fund and how we actually manage money, what kind of companies we invest in, and what are the characteristics of the strategy. We look to find Israeli companies with competitive technology advantages. This could be either high-tech companies or what we refer to as low-tech companies with a cutting-edge technology. An example of a low-tech company actually is Iskar, a metal cutting tools business that was acquired by Warren Buffett in about 2010 for $6 billion US. Notably, this was Berkshire Hathaway's first investments outside of the USA. We typically invest in mature companies that have products and global market advantage due to cutting-edge technologies and intellectual properties that which actually gives them their benefits compared to their comparables. Our sweet spot are companies that fly under the radar with low analytical coverage and that trade at significant discounts to their true value, and therefore have the prospects of earning outsized returns for our investors. The privatization and listing of the stock exchange, as actually Adam and Segi mentioned, kicked off a new opportunity in pre-IPO capital raising. This is very positive for us because it has resulted in the surge of IPOs and increased interest in pre-IPO capital raising. We are very well placed to participate in this deal due to our strong relationship across the domestic market. Our fund is a long-only fund, investing in Israeli and Israeli-related companies listed in Israel or abroad. We will typically hold about 25 to 35 companies. At that moment, we are holding about 34. Our largest current position is 5.5% in biotech, which we spoke about. But we generally hold position of around 3.5 to 4% in each company. Our average market cap is $400 million US, but we have quite a range with the smallest company in our portfolio beginning in $50 million US, which is Epsilon Brands, and the largest being $14 billion US, which is Nice Systems, a duly listed company in Israel and the Nasdaq. And we invest in with a long-term lens, typically turning over the portfolio once every 4 years. Our focus is strictly on Israeli companies listed either in Israel or on different exchanges around the world, but as you can imagine, mainly in the US. Our fund has its unique portfolio construction that incorporates 3 different strategies into a single fund: value, growth, and special situations. It is important to emphasize that these strategies are not implemented in equal weight, and they're determined based on the opportunities in the market at any point in time. I think that we actually sent you in the letters and we spoke with a few of you about the changing over the time between the weight in value and growth. Firstly, value. Valuations are paramount in that strategy, and investments will generally be into much more industrial companies with a distinct technology advantage. Investments will be made with a strong margin of safety when comparing price to valuations. In the growth strategy, in this strategy, we provide access to Israeli innovation edge, focusing on companies with significant and exponential growth potential. Many of these are listed, duly listed or listed only in the NASDAQ. Thirdly, the special situations. Although it's the smallest allocation of our portfolio, these investments provide potential for the highest returns, often through investments in corporate actions that can have significant upside. This is the only strategy in the fund where we invest with a much shorter term outlook. Usually it's up to 12 months. We also have a policy of hedging our downside exposure, which are sometimes referred to as our fourth strategy. This not only protects the value of the portfolio, but it also allows us to make investments when equities are severely oversold and cheap. I'll mention it later, but it's happened twice in the last 3.5 years. We implement this hedge by buying long dates, out of the money, put options on the index, mainly on the Israeli markets, but not only. We bring together all of our vast knowledge and experience in each strategy and implement it into a single fund. Notably, this is different to what we do in our other funds, which are single strategy funds, one dedicated to growth and the other one to value. We believe that in today's constantly changing environment, implementing these different strategies in one fund allows us to our product to really deliver our best ideas and the best of what Alpha Perform has to offer. We unconstrained, we can be flexible and react quickly, and obviously we benefit from the dedicated fundamental research we do across the businesses in existing and new companies for the fund. Most importantly, we are here on the ground in Israel, right in the middle of the action. While we have high degree of confidence in our long-term valuations, of course, of our portfolio companies, we recognize that in times of severe markets dislocations, market valuations are likely to be negatively impacted. Our approach is to protect the portfolio against fall of more than 15% in a specific year. In order to achieve this, we employ an active hedging strategy and roll approximately 25% of our hedge every quarter. A key benefits of having this downside protection is that it provides us with the liquidity in the event of the market crash and enable us to confidently take advantage of the great opportunities that present themselves in times of crisis. We do it by both specific stock selections as well as increasing our weight in the growth section of the portfolio. As you can see in the slide, in the last 3.5 years that the Australian fund has been operating, amazingly, but there have been 2 large market drawdowns. And in both instances, we have performed strongly on a relatively basis. We were able to take the advantages on the downside protection strategy, using the money from the put options to buy equity, mainly growth companies, and adjusted our options strategy. Both works very well for us and help us a lot in those 2 crises. To summarize our presentation, I would like to point out the following points. We truly believe Israel offers a unique diversification for Australian investors as part of their global equity exposure and long-term investment opportunities. Israel tech leadership is globally renowned and captures some of the most innovative and disruptive companies. The fund's unique combination of several investment strategies and theses allows us to be flexible and exploit different investment opportunities in the market. The fund is tech-focused and constantly strives to invest in high-growth industries. We invest in companies with competitive technological market advantages. Many years of experience and strong track records in the Israeli capital markets allow us, allow you, as Australian investors, to be exposed through us to a local fund manager to a market which is typically hard to access. I'll pass it into Adams. Thank you very much for everyone.
Great, thanks guys. That was a very comprehensive overview. We do have quite a few questions that have come in, and it is 4:45 here in Sydney. So I'm going to ask you to be reasonably brief in answering these questions, and we'll try and get through all of them. First question is, do you only invest in companies that are cash flow positive?
So I can't say we invest only in companies with a cash flow positive, because we should divide it into the different two strategies, value and growth. Of course, in the value, all of them are cash flow positive. Actually, most of the growth companies are with a cash flow positive, but there is you should divide the growth strategy into two different segments. One are companies, growth companies like NICE, Camtech, that are with a cash flow positive, but companies like Electrion and Pulse and More, the ultrasound that I just described, are with a disruptive technology, are without cash flow positive. If I'll look at the fund at that moment, I think about 10 to 15% of the fund invest in companies without cash flow positive.
Great, thank you. Next question is, we've spoken about the companies that buy out the Israeli companies, and apparently the examples that we showed were predominantly US companies. Are there examples of Asian companies buying out the Israeli companies as well?
Yes. It's very difficult to answer, but I think there are some regulations problems, mainly for companies that works mainly with the US. So we saw few Asian companies that acquired Israeli companies, but not that many yet.
Okay, great.
Just to add to that, Adam, that Camtech that Gabi spoke about is 20% held by a Taiwanese company, as I mentioned.
Okay, great. Sagi, the next one possibly for you. What is the minimum investment and what are the liquidity terms?
So the minimum investment for this fund is 250,000 Australian dollars. And the liquidity, this is a monthly NAV, so liquidity is on a monthly basis.
Great, thank you. And Gabi, can you tell us a little bit more about the hedging policy? You've spoken about rolling quarter of the hedges every quarter. How far out the money, how much do you typically spend on the hedges?
Yes, it's difficult to describe because it's very complicated, but I'll start by answering how much we spend on it. So actually we spend about 2.5% per annum. But again, it's very, we should look on the overall, because in last year, in 2020, actually because of the hedging strategy, we earned money because we sold part of it in the end of March 2020. So it's about, but it should be, I think, around 2 to 2.5%. Usually we tried to have in an average long date put options. When I say in long date, I say in average about 9 months, and usually it's about 15% out of the money. But again, it all depends on the situations in the market, the valuations of those put options, etc. Today, different from all the last I think in the last 3 months, different from all the first 3 years of the fund, it's the first time that we divided the hedging strategy into 2 different segments. About half of it are put options for 9 months, around 10% out of the money, and half of it are for around 3 months, but much more closer. The reason for that are not only valuations, but it's because the market corrected and actually went up very high quickly, and we want to protect also shorter term. That's the reason. It's managed by us all the time, of course.
Great, understood. Next question, how volatile is the shekel, and should we expect in the Aussie share class that the volatility of the shekel will impact returns?
The shekel actually is one of the strongest currencies in the world in the last few years. I don't think it's that volatile. Even during the missiles that were hit, nothing happened actually to the shekel. It's still strong for many years. I don't think it's gonna influence at all because it's hedged. We've got 2 different classes, the AUD and the USD, and it's totally hedged. So it shouldn't influence on the fund at all.
Okay. And last question, are you holding any unlisted companies at the moment? And if so, what percentage of the fund would be in unlisted?
So for the moment, we do not hold any unlisted companies. There are 2 companies that we engage with them, but the investment is going to be in the IPO. So we have a contract with them, but the deployment of the money is going to be only in the IPO. So all of the companies are listed actually.
Great. Thank you very much. That takes us to the end of our questions. So thank you to everyone for joining us. We hope that this has given you a taste of why we are so enthusiastic about Israel as an investment destination, and why we feel that the way Alpha runs the strategy makes such sense, because it gives holistic exposure to the Israeli economy when most people would have no other points of access to it. So thank you very much for joining us. If you have any other questions, please get in touch. We'd love to hear from you. Enjoy your evening. Thanks very much.